The very fragile peace deal with Iran looks like it's falling apart, and the stock market is getting ready for a big hit on Monday. All eyes are back on the Strait of Hormuz, which means oil prices are starting to creep up, and S&P 500 could be in for a very rocky Monday morning. For weeks, everyone was feeling hopeful that the conflict was cooling down. Now that the hope is disappearing and past, in this video, we're going to cut through the noise and show you the exact price levels you need to watch. So, to understand what's about to happen, you first need to understand what just happened. The market isn't just reacting to bad news. It's reacting to specific hope that just got ripped away. Okay, just this past Friday, April 10th, the S&P 500, ticker symbol SPY, jumped up to close at $679. That was the first week it had finished in the greens the last 6 weeks. But it wasn't because of good economic news. It wasn't because of good corporate earnings. It was a relief rally purely because everyone thought a 2-week ceasefire was a done deal, right? Before that, the market was on the verge of a full-blown panic. It had already dropped almost 10% from its high back in January as the conflict got worse and the oil shot up towards $120 a bit. And the ceasefire was the only thing that pulled us back from the edge. But now that the deal is reportedly toast, analysts are calling it a whiplash. All those gains from the last week are totally exposed. The big fear is that the market will gap down on Monday, which means it could open so low that it erases the entire week's rally in a single morning. And it all comes back to the one thing that started this whole mess: oil. So what does that mean and how it affects the entire market from technology to finance stocks? From the market's point of view, this entire conflict is about one thing and only one thing: energy. Even with the ceasefire supposedly in place, Brent crude oil was still over $95 a barrel, and the West Texas Intermediate was over $97. That's 40% higher than before the conflict started, which tells you the market never really bought into the idea of a long-lasting peace. The reason why everyone is so skeptical comes down to the Strait of Hormuz. This little strip of water is the world's single most important bottleneck for energy. About a fifth of all the oil in the world passes through it, plus 25 to 30% of all liquefied natural gas, or LNG. If Iran ever threatens to close it, that doesn't just mean you pay more at the pump here in the US. It threatens a massive energy crisis in Europe and Asia. All right, you have to understand it. A new spike in oil prices would bring back the market's worst nightmare, stagflation. And it means the interest rates are going to go up again. That's the awful combination of a sold out economy and prices for everything going through. This is the absolute last thing the Federal Reserve wants to see. Just when they're hoping inflation is finally starting to chill out, an oil shock could send it soaring all over again. That could force them to raise interest rates and raise them aggressively. But for the stock market, that's the worst case scenario. Higher rates crush stock prices, while a weak economy kills company profit. It's a 1-2 punch that gives investors nowhere to hide. Okay, but what does that mean for the tech and AI whiplash? That 1-2 punch is especially painful for the stocks everyone loves: tech, AI, semiconductor companies. They get hit with the triple threat: soaring energy costs, higher interest rates, and lower demand. First, their stock price gets hammered. Tech and AI companies are often valued based on profits they hope to make years down the road. That's why they have huge valuations. When the Fed raises interest rates, those future profits are worth less today, which can slam their stock price. Second, an energy crisis is a direct hit to their bottom line. The giant factories that build the chips for AI and all our gadgets known as fabs use an insane amount of energy, sometimes as much as a small city. Higher energy prices squeeze their profits directly. And finally, in a stagflation world, demand dries up. Companies put big AI projects on hold, and regular people wait longer to buy new phones and laptops. So for chip makers, it's a total nightmare. Demand for their products is falling right as their cost to make them soaring. So these stocks led the market up, and in a sell-off, they could lead the market right back down. All right. And since 2022, what the market is driving is all the AI and tech stocks. If you've been following the market, this all probably feels a little like a bad rerun. The pattern of getting your hopes up just to have them crush has taught investors to be skeptical. That little rally we just had was nice, but it was built on shaky ground. And that was a huge gap going to that rally. History gives us a pretty chilling lesson here. Usually, geopolitical shocks cause a quick dip, and S&P 500 bounces back in about a month. But there are two major exceptions when the event causes a huge oil crisis. The 1973 oil embargo and 1990 Iraq invasion of Kuwait both caused the market to drop by double digits and led to long downturns. The 1973 crisis kicked off a terrible period of recession and inflation. It took the S&P 500 6 years to get back to where it was. And that is the history lesson every investor should be thinking about right now. I'm not saying you should all be fearful and sell everything, but I'm going to tell you what to do in this chaotic scenario. What should you be looking for on Monday morning? If your deal is officially dead by the time the market opens, you can expect the S&P 500 to open much lower, possibly dropping between 1% to 3% right away. The stocks that led the charge up will probably be the first of all. Take the big banks like Goldman Sachs, JP Morgan. They shot up over 4.71% and 3.68% when the ceasefire news broke. But in a stagflation world, banks get squeezed because fewer people take out loans and the risk of current loans going bad goes up. Those stocks are not extremely that vulnerable. On the other hand, energy stocks might get a quick boost as the oil prices jump, like Exxon. But you have to be careful. If the whole market starts to panic, even energy stocks can get dragged down because of fears of a global recession, which would eventually crush oil demand. From a technical perspective, S&P 500 closed at $679 on April 10th. The first important level to watch is the big psychological number. It's 660, which is 200 moving average on the daily. If it breaks below that, it's a very bad sign. The next major support is around 650 levels on 50-day moving average on the weekly. But the most important thing to watch on Monday is the VIX, which is basically the market's fear gauge. It had calmed down a lot during the rally, going all the way to 18s, almost 17% drop. If you see the VIX spike back over 25 or 30, that's your signal that the big Wall Street firms are heading for the exits and they're buying puts, which is going to increase the put prices a lot. So heading into this week, it's all about the headlines from the Middle East and the price of oil. We're now in a spot where the chance of a really big move, either up or down, is much higher than normal. The ceasefire deal could be saved at the last second, which would send the market flying, or it could completely fall apart, triggering the big sell-off we've been talking about. And the bottom could go all the way to $606 in S&P 500. In times like these, just remember, don't make any emotional decisions, right? While the dangers are real, history shows us that the markets eventually recover. The key isn't to perfectly predict the future, but to have a plan. Know what you own, understand how much risk you're comfortable with, and don't let short-term panic ruin your long-term goal. As the VIX went down to 18 at levels, 17% down from 25-30, I closed most of my positions and moved the cash because I knew when the greed was there, I needed to be fearful and I could have cash on hand to allocate when the VIX spikes again because I knew it was just a 2-week deadline. There was no done deal. So I had to be cautious, right? And there was a huge gap up on the S&P 500. So let's see what the Monday is going to do. And check out my latest video to see what kind of trades you could be taking and how to use volatility. And if you like this video, make sure to subscribe and hit that notification bell and like the video. Thank you for watching, and I'll see you in the next update.